So what's the best thing for you to do with your own stock options? Well, I recommend looking at this from a financial planning perspective to address a few questions as far as, how much of this stock do you already own? How much are you going to need to retire? What are the tax implications of this decision? Do you need money in the short term, such as for paying for college costs or a wedding? And, how do you manage and protect what you've accumulated in the most efficient way?
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. In this week's episode, we're going to talk about non-qualified stock options. If you happen to work for a publicly traded company and part of your compensation is in the form of non-qualified stock options, then there are definitely a number of things that you should be aware of regarding those options. So, what is a non-qualified stock option? So, a non-qualified stock option, it gives you the right to participate in the appreciation of that publicly traded company. So, you're given a certain amount of options, and they're assigned to you on what's known as the grant date, and that's the date that you receive the options. And the value of the shares on the day that you receive them is known as the exercise price. That's the value that's used going forward to determine whether or not these options you received have profited you. And then there's a vesting schedule where a certain amount of the shares are available to you on a yearly basis after a certain point. So let's just say that you were granted 1,000 shares, and after 2 years, then you're able to exercise 25% of those shares per year, so 250 shares. Your options also come with an expiration date. There's a certain period where if you have not exercised your options, then your options expire. And that varies, but a lot of times that's 10 years. And another thing is that many times when you leave a company, if your options have not vested, they could also expire. When you leave the company, you could no longer have the right to exercise those options. Like most compensation, your options are taxable to you depending upon how you handle them. Now, when you receive the options, when they're awarded to you, there is no taxation. And it's only when you decide to exercise the options that the options become taxable to you. Options are taxable in the year that they are exercised. And there are two components to how your options are taxed when you exercise them. And that's the taxation of the options when you exercise and also the taxation of the options after you exercise. And we'll start first with the taxation of the options at exercise. And the way that that taxation works is that the difference between the price that you exercise the option, otherwise known as the fair market value, and the grant price, the price that they were awarded to you at, is taxed as ordinary income. So that counts as earned income, which means it's also subject to Social Security and Medicare. It's similar to other earned income that you get a W-2 for. So this would get added to any other income you have for the year to determine the tax rate that you would pay on this. And if you have a large option or a large amount of options you're exercising in 1 year, then this could push you into the highest federal tax brackets very quickly. And once you exercise the options, so once you're buying the options, then any tax after that depends upon how long you hold the shares. So if there's a gain beyond what you pay to exercise the options and you hold them for less than a year and you completely sell the shares that you've exercised, that's taxed as a short-term gain. But if you exercise the shares and you hold the shares for longer than a year, then that's taxed as a long-term gain. Obviously, that would be preferable, but there's certain things you have to be able to do, which we'll talk about in a second. So let's work through an example, a simple example, so that you can get a better understanding of how this would work. So let's just say you were granted 100 options and the company that you work for granted them to you at $10 a share. So it would cost you 10 times 100, which is $1,000 to buy these options. And today, the value of that stock has doubled. So it's now $20 a share. So if you were to exercise these options, as I said earlier, the difference between the grant price, which is $10, versus the current price or the fair market value is $20. That $10 per share times 100 shares, that $1,000 is taxable in the current tax year that you exercise at $1,000. So that would be earned income to you reported on your W-2, subject to Medicare and Social Security, as well as federal and state income tax. So that's what you would end up owing. Now, you could decide when you exercise to keep holding those shares. If you're confident that you think those shares will go up in value in the future, then you could hold those shares, and at some point in the future, you then sell them. Let's just say you end up selling them, the shares double from there, and they go to $40 a share. So you own 100 shares, and you end up selling them later on for $40 a share. So that is $20 gain over what you initially bought them for. So that $20 times 100 shares is the capital gain that you have. And if you've held those shares less than a year, then that's a short-term capital gain, which is currently taxed as ordinary income rates. The only savings that you have versus the taxation at exercise is that you're not having to pay Social Security and Medicare on that. That's just going to be subject to state and federal tax. And if you held them longer than a year, then they're taxable at a long-term gain, which for everyone except for the people in the highest two federal brackets, this is taxed at 15%. Plus, there could be an additional what's called the Medicare surcharge tax. But that's a definite savings for many people having it taxed at 15% versus 22% tax bracket or higher, which is where most people find themselves. The issue is that if you're going to pursue exercising your options and then holding them for a long time, you have to have the cash. Now, in the example I used, you'd only need $1,000, not a lot of money, but chances are that if you're being granted options that are more in number than that example, and also the price could be a lot higher. So if it costs you, let's say, $50,000 or $100,000 to exercise your options, then you need to have that cash available to you. Now, if you do, great. You could use that cash, exercise the options, and you could hold them for over a year and sell them, and there'd be tax preferential treatment to you on the gain after exercise. But you'd have to be confident that you thought the value of that stock was going to go up. And obviously there's risk with having a concentrated position. So that's if you're going to exercise and you're going to hold. The other option is that you could perform what's known as a cashless exercise, where depending upon the company that you have your options with, the company that you facilitate the transaction through will front you the money to exercise the options. And then once the shares have been exercised, you sell a certain amount of shares to pay back the company that's loaning you the money. Let's just say that you had options that were worth a couple $100,000 and it was going to cost $50,000 to actually buy the shares. So you have a $150,000 gain. Then what you could do is you could go through a brokerage company that would front you the $50,000 to buy the shares. And once you own the shares, then you sell $50,000 of the $200,000 that the options are worth to repay that company back. And you end up keeping the $150,000. So that's a cashless option. Another way to raise money is you could use a home equity line of credit, right? You could use some other borrowing option to raise money to exercise the options. But I caution you that obviously this comes with a lot of risk, because if all of a sudden something happened to the value of that stock and it went down significantly, or was worth less than what it cost you to buy the shares, well, now you owe this money on a mortgage, which could put you in financial difficulty. So you want to be really careful anytime you're going to pursue that option. So there are really three strategies that you can use with your options as far as how you approach them. One is that you could exercise and sell immediately. This could be done with your own cash, that you use your own cash, buy the options and immediately sell them. Or this could be done through a brokerage company that would help you to do this as a cashless exercise. Option 2 is that you end up exercising and you hold them. If you're really bullish on the company, if you are okay with having a large amount of your net worth in one company, and there's lots of examples of people who have done very well having a lot of their net worth in one company, and there's obviously examples of how this has gone horribly bad for people. So if you're comfortable with that, then that is option 2. And option 3 would be that you wait towards the very end of when the shares are going to expire, and then you exercise and you immediately sell. For whatever reason, this is what a lot of people end up doing. I think they're waiting as long as they can to see how the options could grow. And they also don't want their options to expire, especially if the options have a value to them. There is, however, an additional way that you could have your stock options taxed. And rather than waiting until you're able to exercise and paying tax on the difference between the exercise price and the fair market value, you could take advantage of what's called an 83B election if your company allows this, and you would pay tax before you're able to exercise the shares at potentially a lower rate. So let's go back to our earlier example where you were granted 100 shares at an exercise price of $10 a share, and by the time you were able to exercise them when they vested, the price had gone up to $20. But let's say instead you were able to pay tax on those shares at not $20, but at $11. So you'd only have a $1 gain per share. So you have the ability to do this, but let's just say you did that and you paid tax on this money in advance at the $1 gain per share. So you're paying tax at $100. If those shares end up becoming worthless, you've paid $100 of tax and you have nothing to show for it. So that's the negative, is that yes, if your company allows this, you can pay tax potentially at a lower rate if the stock appreciates. But if the stock doesn't appreciate, or if the options expire worthless, then you've paid tax where normally you wouldn't pay tax unless you exercise the options. So you have to have a really long-term holding period for these shares and be comfortable with that risk to think about this. So what's the best thing for you to do with your own stock options? Well, I recommend looking at this from a financial planning perspective to address a few questions as far as, how much of the stock do you already own? How much are you going to need to retire? What are the tax implications of this decision? Do you need money in the short term, such as for paying for college costs or a wedding? And, how do you manage and protect what you've accumulated in the most efficient way? So you really have to factor all these things into your decision-making process to decide maybe it is right for you to do a cashless exercise and sell your shares right before retirement. Maybe it makes sense for you to spread out the sale of the shares and do it over a number of years to lower the taxes that you could pay. Maybe it also could make sense to buy the shares and hold them for a long period of time. Everyone's situation is unique. And this is where the value of a financial planner can really come into play and help you to map this out. So as always, I hope that you found this episode informative. If you haven't already done so, please leave me a 5-star review on Apple Podcast or your favorite podcast app. And also any comments that you have would be greatly appreciated. I hope that you have a great week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.